Hey everyone, me Kevin here. Let's talk about inflation expectations because guess what's happening tomorrow? Tomorrow we have the CPI data release, which does mean I will be up at 5:30 in the morning, which is kind of crazy, but I'm going to be up at 5:30 in the morning. So if you want to see the CPI data release live, I will be covering it. But first, let's talk about what expectations are and what happened last month. Because last month, we got inflation data that let us know how did prices change for consumer prices between April and May. Now we're going to get price changes between May and June, since we're in July, and we're going to learn about June inflation readings. Now, the first thing that's really useful to do is know where we had some big pain points last time. And that was here on things like car and truck rental prices going up 12.1% month over month, which is insane. That's a massive bump. 4% increase in public transportation, 7% increase in airline fees. These are some big numbers. So this month, comparing essentially the end of May or the middle of May to the middle to end of June, we want to potentially see those airline figures, those ticket prices going down or stabilizing. See, 0 means they're still up, right? And that's important to know. Easy way to picture this is here. Actually, let's explain it like this. Go over here. If, let's say, an airline ticket is $100 and then next month, which is insane because it'd be like a doubling on an annual rate, but next month the airline prices are $112, that's a 12% increase month over month. We want to potentially see that stay at, let's say, go to 113, that's a little less than 1%, maybe even stabilize where we have a 0% bump month over month. If we get something like, oh, it's 120, that's still a big bump. We're still getting a large push in things like airline or car rental truck pricing, right? Or, which could be really good for inflationary purposes, we see airline prices or car rental prices or whatever start coming down again to something like, oh, it's going to go to 110. Now we actually have month over month deflation. So that's going to be pretty big. We're going to be paying close attention to what the numbers look like in the other aspects, like within the data, or as Jerome Powell says, under the hood. This is really important. Now, headline news is probably not going to pay attention so much to the weeds like we do, but as investors, we like to pay attention to the weeds. What I can tell you, the Bureau of Labor Statistics article is likely going to show on most headline news articles is going to be something as simple as this is how much inflation we had month over month in June. And month over month in May, we had 0.6%. 0.6%. For the expectations for June, at least what Wall Street believes, we think we're going to see 0.5%. That's what Wall Street thinks. So if we hop on over here and we draw this out, we can see if Wall Street expects 0.5%, last month was, this we'll put last month was 0.6%, then we can kind of take a little bit of a guess in terms of what we would expect in the actual market and kind of reactions for the market. So if, let's say, month over month inflation, which is much more important than the big headline number. Last month, the big headline number was having 5% inflation, which is crazy. That's year over year. So this is month over month, and this is year over year. The current expectations are 4.9% for a year over year measure in June. Now, I personally believe that this number should start declining rapidly here, potentially in July, but more likely by September and October. So this, ideally for June, what we're looking for, in my opinion, is a number that's stable or slightly lower, which is actually what Wall Street is expecting. And then we're on course for hopefully a better inflection point to the downside with inflation by September and October. In September, October, I believe these numbers are going to be under 3% again year over year. Now, let's estimate what we think and how the market might respond to this, right? So first things first, let's talk if the headline number, so we're going to do headline number first. If the headline expectation is 4.9% and we come in with something like 4.4%, I would expect things like tech and consumer discretionary to do very well. If inflation numbers come in higher, something like anything really with a 5 in the front, I would expect banks and financials to do better. And the reason I would expect banks and financials to do better is generally as interest rates rise, their profit margins can go up. The same would be true for something like a Rocket Mortgage. But the more we have interest rates potentially trend downwards because inflation risks are subsiding, then it's no surprise that we see like Rocket Mortgage or United Wholesale Mortgage Company, these sorts of companies do poorly, or banks maybe not do as well as they previously have. One way that you can kind of see how the market is expecting changes in inflation is by looking at the 10-year Treasury yield or the 10-year break even, which works with tips. I'm just going to keep it pretty simple, and I'm just going to look at 10 years. Usually what I do, I look at 10-year inflation levels, or sorry, not 10-year inflation levels. You look at a chart of 10-year Treasury bonds. And when you pull that up, you see this big fear of inflation starting around February of this year. And that kind of fear of inflation really escaped starting, I'd say, somewhere around April and May, which is really interesting because April and May is right when we started getting CPI data that was at its highest point. And that's, in my opinion, when the market started realizing, wait a minute, the things that are causing the big inflation that we're seeing in April and May, this is a chart of the 10 years here, those things are temporary, and those are going to go away. So even though we went into these high inflation expectations of, oh my gosh, we might see hyperinflation, when we actually started getting the high inflation reports, inflation expectations started waning and subsiding. Commodity prices started collapsing. We started seeing the collapse of crypto prices, which are somewhat and sometimes often seen as an inflation hedge. And so we start seeing those sorts of prices collapse or fall because the inflation data is showing, wait a minute, the inflation is only in temporary things, again, like airline tickets or rental cars and things like that. Well, then it's no surprise that we see these treasury yields go down, and we see some of the other aspects of markets expecting lower inflation. Now, when I say the markets potentially expect lower inflation, know that not everyone agrees that inflation is going to be lower. In fact, around 50% of people think inflation is going to be worse. We even have this New York Fed survey that just came out in June, which says that the public expects inflation to hit 4.8%, and 3 years from now believes that inflation will still be around 3.6%, which I expect in about 1 year will be at potentially even under 2%. So I personally believe that we'll have much lower inflation, but I just want to make that clear because it's kind of a 50-50 thing, like which side of the coin are you on? Or maybe you're even in the middle, right? But expected inflation a year from now, so 12 months out, the New York Fed survey of the public indicates the public thinks right now that we're going to see 4.8% inflation. And now this is the highest level of this survey going back to 2013. So in other words, a year from now, the public still thinks inflation is going to be over 4% and over 3% 3 years from now. This is potentially, in my opinion, because right now we are in a moment of seeing high temporary inflation, high wages going up in retail sectors and businesses reopening, wages going up in hospitality, prices for airline tickets, prices for cars, all these things going up. But a lot of these things are temporary and associated with a reopening. In fact, when you look at jobs data, you look at the jobs report and you take out hospitality, you're like, wait a minute, wages only went up 0.1%. which is an annual rate of 1.2% for wages not related to the reopening. In other words, things that are related or potentially propped up because of the temporary supply shortages of, oh my gosh, we got to reopen really fast again, right? So let's go back to expectations here. If we see something like 4.4 to 4.6%, somewhere around here, I'd expect tech, consumer discretionary to do pretty nicely. Tesla, Etsy, some of these others. Right here, I think we will, let's see, around 5% or above. I think banks will start doing well. If we get something in the middle, it'll be a pretty neutral kind of response as an expectation. So then if we jump on over to here, let's do just an expectation on month over month. So the month over month expectation is going to be 0.5. I think on month over month, honestly, anything under 0.3 is just going to be potentially even just euphoric. I don't think we're going to get anything under 0.3 month over month because we're just not at that inflection point yet. I think we'll start seeing these numbers in September and October unless we're starting to see that deceleration happen even faster. So that's going to be a key marker here. Is that we're going to get under 0.3? I don't think so, but that would be a big deal. Now, if we ended up month over month getting anything crazy, which crazy in my opinion would be like 0.9% or above, that would be bad for consumer discretionary tech, good for banks and some of the financials, right? So hopefully this gives you a little bit of a guide. Again, I'll be live streaming this at 5:30 a.m. California time tomorrow, 8:30 Eastern time. And folks, hopefully you enjoyed this sort of preview of what to expect tomorrow. Thanks for watching, and we'll see you in the next one.